Welcome to this video presentation. I'm teacher Shirley DeCosta, your economics teacher. Let me take you through the relevant material on the topic government budget and functions. We will go through the following: meaning and objectives of government budget, components and structure of government budget, tax and non-tax receipts and the types of taxes, types of deficits, fiscal policy and measures to curtail deficits, and types of government budget. What is a government budget? Government budget is a statement of the estimates of government receipts and government expenditure during the period of the financial year. Or, government budget is a statement of expected receipts and expected expenditures of the government for the financial year starting from April 1st to 31st March of the next year. It also includes government report on its financial performance over the past 1 year. What are the objectives of government budget? It is a reflection of government policies and a set of objectives that the government seeks to fulfill through the budget. The first objective of government budget is redistribution of income and wealth. The government uses fiscal instruments of taxation and subsidies with a view to improving the distribution of income and wealth in the economy. Here I would like to mention that when the government taxes, the income earned through taxation is redistributed in favor of low sections of society by means of subsidies. Let us go to the next slide. The second objective of government budget is reallocation of resources. Through its budgetary policy, the government of a country directs the allocation of resources in a manner such that there is a balance between the goals of profit maximization and social welfare. For example, the production of goods which are injurious to health, like cigarettes and alcohol, is discouraged through heavy taxation, while production of socially useful goods like LPG is encouraged through subsidies. The third objective of government budget is economic stability. The government of a country is always committed to save the economy from business or trade cycles. Business cycles refer to the phases of recession, depression, recovery, and boom in the economy. The budget is used as an important policy instrument to correct the situation of deflation and inflation. I'd like to remind you here that deflation is a situation of fall in prices and inflation is a situation of rise in prices. Let us go to the next slide. The fourth objective of government budget is managing public enterprises. The budgetary policy of the government shows interest of the government to increase the rate of growth through public enterprises which focus on social welfare rather than profit maximization. What are the components of the government budget? The government budget is divided into two components broadly, one being revenue budget or revenue account and the other capital budget or capital account. The revenue budget in turn is divided into revenue receipts and revenue expenditure, and the capital budget is divided into capital receipts and capital expenditure. I'd like to mention here that in the case of revenue receipts, whenever any income is expected to be earned here, it will not be due to a sale of any asset or it will not be due to borrowings. Therefore, we say that in the case of revenue receipts, there is no reduction in assets and no creation of liability. So also here, when the government expects to spend from the revenue expenditure account of the revenue budget, There will be no reduction of liability, which means they will not be paying off loans from this account. Neither will they spend money to create any assets. So it is said that here there is no reduction of liability and no creation of assets. Likewise, in the case of capital receipts, there will be reduction in assets, because when the government sells an asset, the money received is expected to be put in this category. And there will be creation of liability, because borrowings also will be included here. So we say in capital receipts, there is reduction in assets and creation of liability. While in capital expenditure, the money in this account of the capital budget will be used to spend on creation of assets or purchase of assets like shares, bonds, or any other investment of the government. And this money will also be used to pay off loans. So we say that in capital expenditure, those items will occur wherein there is creation of assets and reduction of liability. The revenue receipts again is divided into tax receipts and non-tax receipts. I will explain these two in the slides that follow. Examples of revenue expenditure are wage bill, interest payments, subsidies, and defense expenditure. I'd like to mention here that when the government plans on borrowing, that amount will come in under capital receipts, whereas interest payments will come under revenue expenditure. So here you see that we have recovery of loans, borrowings and other liabilities, and other receipts, perhaps from the sale of some assets. Capital expenditure can be divided into plan and non-plan. And here are some examples. Expenditure on land and building, expenditure on machinery and equipment, purchase of shares, and loans by central government to state governments. Let us go on to the next slide. Here are some examples of tax receipts and non-tax receipts. We have an acronym here to help you to remember the various tax receipts and non-tax receipts. So you have sales tax, estate duty and custom duty tax, income tax, gift tax, excise duty, and corporation tax. The non-tax receipts are escheat, fees, fines, income from public enterprises, income from sale of spectrum like 4G, 5G, grants and donations, and special assessment. Fees are the payments made to the government for various administrative services rendered by the government, like registration of birth, registration of marriage, registration of death, and so on. Fines is a form of economic punishment that is imposed on lawbreakers. Escheat is the income that is earned by the government from the sale of such properties which have no legal heir. Special assessment is the money recovered from the owners of such properties whose value has appreciated on account of developmental works made by the government. Let us go on to the next slide. Tax receipts. What is a tax? A tax is a compulsory payment made by an individual or a firm to the government without reference to accepting anything in return. The types of taxes. Taxes could be referred to as being progressive and regressive. There are ad valorem or VAT taxes. There is the specific tax. There are indirect taxes and direct taxes. An example of the direct tax is income tax, and an example of indirect tax is the goods and service tax, which we commonly refer to as GST. Let us go on to the next slide. Let us go on to study the progressive tax and the regressive tax. We have here the first illustration of a man sitting on a big pile of money. He belongs to a higher level of income group. And you see a man here sitting on a smaller pile of money, signifying lower levels of income. He pays a comparatively less amount in terms of taxes, whereas the man earning a higher level of income is paying more in terms of taxes. This is because the rates of tax increase with the increase in income. So it is progressive in nature, in the sense that it puts lesser burden on the purchasing power of the man belonging to lower income group. You have the corporate tax here, which is the tax imposed on the profits made by firms. Then you have the capital gains tax, which is a tax made on the profits people or firms would make through the sale of some asset. It could be a property, it could be shares or bonds, and so on. As opposed to this, you have the regressive tax. You see here there is a person earning a sum of 1 lakh, person A, and a person B earning a sum of 2 lakhs. Note that both of these are paying the same rate of tax, and that is 20,000, which means that this tax is regressive in nature because the person belonging to a lower level of income is paying the same amount of tax as the person belonging to higher level of income. So in that sense, it is regressive in nature. Typical examples of this kind of tax would be the goods and service tax, the property tax, and the VAT. I would like to mention here that the VAT is still applicable in the case of alcohol, fuel, and registration charges of cars. Though we have done away with the old regime and we have the goods and service tax regime now, the VAT is still applicable in the case of alcohol, fuel, and registration charges of cars. Let us move on to the next slide. Value added or ad valorem tax. We see here the goods are produced in the house of the manufacturer, which are sold to the distributor. A value is added by the manufacturer and the goods are sold to the distributor, and the value added is 105. The distributor buys the output from the manufacturer for 105 but adds value and increases the value of the output, then becomes 210. The retailer buys it from the distributor at 210, adds value and sells it to the consumer at 525. The tax which is imposed on the value added at each level of production or distribution. As opposed to that, we have the specific tax which is imposed at the level of the manufacturer on perhaps the value of the goods produced per unit. What are the types of deficits? Well, there are 3 types of deficits: the revenue deficit, the fiscal deficit, and primary deficit. Let us define each one of them. Revenue deficit is the excess of revenue expenditure over revenue receipts, which means that revenue expenditure is greater than revenue receipts. Fiscal deficit is the excess of total expenditure, revenue and capital, over total receipts, revenue and capital other than borrowings, which means that the total expenditure of the government is greater than the total receipts. And lastly, primary deficit. Primary deficit is the difference between fiscal deficit and interest payment. What is fiscal policy? Fiscal policy is the discretionary action by the government to change the level of government expenditure on goods and services and transfer payments, and the yield of taxation at any given level of output. What are the measures to curtail or control budgetary deficits? There are three measures. First one is lowering government expenditure, and the second one is raising government receipts. Lowering government expenditure. The government will try its best to reduce all unnecessary expenditure. They will try to avoid reducing development expenditure as it is necessary. Also, they will try to not to touch subsidies to a large extent because they are needed by people of lower income groups. So also they may not decrease defense, law and order expenditures. Perhaps they may try to decrease that expenditure that is not useful. The second measure, raising government receipts, is divided into two. They try to raise receipts through taxation or disinvestment. Here the government has to strike a balance using direct and indirect taxes so as not to burden the masses. Disinvestment means the sale of equity or process of privatization of public sector undertakings. Disinvestment must lead to further investment. Next is, what are the types of government budget? There are three types of government budget: balanced, surplus budget, and deficit budget. We can call surplus and deficit budget together as unbalanced budget. What is balanced budget? It is a budget wherein government receipts is exactly equal to government expenditure. In the case of surplus budget, government receipts will be greater than government expenditure. And in the case of deficit budget, government receipts will be lesser than government expenditure. So to sum up, we have gone through meaning and objectives of government budget, components or structure of the government budget, tax and non-tax receipts, types of deficits, fiscal policy and measures to curtail deficits, and lastly, types of government budget. Thank you.